Hi, this is Mary. Welcome to Vita Scholars lesson number 4. Today we're going to talk about self-employment, the different types of self-employment, income, the different tax forms the income could be reported on, expenses that are ordinary and necessary to do those jobs, how to enter self-employment in Taxslayer, the effects it can have on a tax return, and Uber and Lyft drivers. So here we go. Remember, you can pause this at any time and rewind it. Also remember that the client is ultimately responsible for their tax return. We can only enter what they tell us. If something seems wrong, fishy, you're just not sure, you don't feel comfortable with it, you have the right to just pause and say, "Excuse me one moment," get up and go talk to your site coordinator. Maybe they have a different way of asking the questions, or maybe they might say, "We need more information," or "We just don't feel comfortable with this," or "We're not trained with this," and we can send them somewhere else. But do not do return you don't feel comfortable with. If you don't know how to do something, ask somebody to teach you and show you, or if they do it, you observe them so you learn. Different types of self-employment that we usually see at a VITA site. We see a lot of home health workers, whether they're CNAs or LPNs. We see construction workers, painters, landscapers, carpenters. We see people who take care of other people, kids and stuff. A lot of Uber and Lyft drivers, a lot of DoorDash, Instacart, realtors, musicians, photographers, people who write books, just all kinds of stuff. And each one of them is a little different. When we're talking about self-employment, we're talking about somebody who works for themselves. Um, they're a contractor. Sometimes they're called contractors, but they work for themselves. Because we are volunteers, we're not CPAs, the IRS limits us on what we're allowed to do. So one of the things is they have to have less than $35,000 in business expenses. They cannot have an inventory at the end of the year. So an example of an inventory would be somebody who maybe does hair and they buy a case of shampoo and they sell the shampoo to their customers. And let's say they buy a case of 12 bottles. They sell 4 during the year. They still have 8 bottles left over. Those were purchased in 2024. You didn't sell them all in 2024. You might sell the rest in 25, but the cost and the sale price are going to be in 2 different years. And so that's an inventory. If you still have product that you sell into the next year, we're not supposed to do those. We're also not supposed to do any that have a net loss from their business. So their income minus expenses. If they had more expenses than income, we're not supposed to do it. They cannot have employees during the year. And they can't have contract labor. So they have to be working for themselves by themselves. If they pay somebody to help them, maybe they're a caterer and they have a big job coming up and they hire somebody to help them for the day, we can't do their return. When you pay somebody, that creates a more complicated return. Maybe there has to be a tax form because you have to report that you paid somebody. And so that's just way out of our wheel well. We're not allowed to do that. They can do it. They just have to go to a different program besides the free volunteer programs. We cannot do depreciation. So any one item that they buy that costs more than $2,500 that's expected to last more than a year, for example, a riding lawnmower, we can't do. We are also not supposed to do business use of home expense. They can claim it. Our program just cannot do it. Part of that is because you need to know the square foot of the room and the house and then all the utilities and real estate taxes, and it gets more complicated. And remember, we're volunteers trained to do simple returns. And for the vehicle, we're only allowed to do standard mileage rate for the car, business miles. We don't do actual expenses. If they want to claim actual expenses, they can. They just need to go to a paid tax preparer. Remember, we can only do simple returns. For free service, we have to limit what we can do. Forms needed. We do not need to see their receipts. We do not need to see their bank statements or their logbooks. We just need the total by categories. They should have records in case they get audited. They can get audited 3, 4, 5, 6 years later down the road. I tell everyone, keep your things for at least 7 years. Self-employed people can get paid in cash, by checks. They might even get paid through credit cards, like an Uber or Lyft driver. Their customers pay with credit cards. There's a third-party app that directs that they can download the money from. There's also expenses. The expenses should be broken down by category or type. For example, supplies or tools or uniforms or postage. Again, we don't want to see all the receipts. We don't want to see every single time they purchased it. But we don't want one big total that says expenses $6,000 because IRS wants to know what it is. We should know what it is to make sure that they can claim it all. Again, we don't need to see the receipts. They should have it broken down for us. Again, they're ultimately responsible for what's on that tax return. I will advise you that there are a few red flags. Now, just because they have a red flag here on this list doesn't mean that the return is wrong or they're lying, just things to be mindful of. So if their income and expenses are all in round numbers, that could be around a big red flag. But maybe they charge everybody $50 for a job. Well, then those would be round numbers. But when you're talking about buying supplies and mileage, big round numbers are red flag. I've never driven anywhere and it's been a perfectly round number. When I buy supplies and things at the store for myself or grocery shop, it's not $100 exactly or $500 exactly, or I spent $1,000 for the year. Those are red flags. If you think the business should have some type of expenses and they say, I don't have any expenses, um, that's a red flag. But that doesn't mean that that's not the case. So you have to ask questions to clarify. I have a lot of clients that clean homes or CNA workers. And depending on their the people that they serve, their clients and their customers and their patients, they're all a little different. So some people who clean houses just show up, and the company that they're working for or the homeowner that they're working for provides all of the chemicals, provides all the equipment, the garbage bags, everything. They just show up. There are some that they have to bring their own chemicals and vacuum cleaners and stuff. So those people have expenses. Same with home health workers. Some have to bring their gloves and their sanitizer and all that kind of stuff. And some just show up. The company provides everything. Some people paint and some people are handyman and they're contracting to other companies. Sometimes they have to bring their own tools, buy their own supplies. Sometimes they just show up. So you have to have that question. Do you have to buy anything in order to make this money? Not your personal expenses. They'll try to tell you what their rent was, what their food was, or electricity. What? No, no, no. We're talking about business. What did you have to spend to make this money? Your business expenses, not your personal expenses. We talked the other day about the earned income tax credit, how it was this round bell-shaped curve, and that very top part that we call the sweet spot. When you have a Schedule C return that just happens to land right there in the sweet spot, that could be a red flag. Are they lying about their expenses and their income to hit that high dollar amount? Maybe it's true, that's the way it works out, but those are red flags to the IRS. Sometimes if they're self-employed and all their income is the form of cash, they don't have any 1099 NECs, that could be a red flag. But I have a lot of clients that are like that. So these are just things to watch out for. Anybody who works for a business, if you're a cleaner, a landscaper, and you're doing your work for a company and that company pays you more than $600 in a year, you should have a 1099 NEC. But if you are cutting grass or doing handyman work for a bunch of homeowners, people, not businesses, you're not going to get a tax form. So these red flags are just things to watch for, but it doesn't mean that there's a problem. Income. Income can be received from individuals and businesses. They can get cash and checks. For example, they cut your grass and the homeowner gives them a $50 in cash. They can also get cash or checks from a business. They work, they clean or they cut grass, whatever it is for a business, and they could get checks or cash. They can also get paid through online apps like Square, Uber, Instacart, PayPal, any of those things as well. It's up to the taxpayer to track all of their income. The two types of tax forms for self employed people are 1099K. This is a third party processing document that shows how many transactions this credit card company processed and how much money that they did process for them. There's a 1099 NEC, which stands for non employee compensation, and this will show all the cash and checks that a company paid to a contractor. And sometimes the clients have their own records. I have one lady who she's a home health worker for two clients. And every year she comes in and she'll have Miss Smith and how much money she made for Miss Smith, and she'll have Mr. Jones and how much money she made for Mr. Jones. She has it all broken down, and I type those out on the return so she can see the itemizing on there. But again, not every self-employed person is going to get a tax form. All income needs to be reported, whether you get a tax form or not. If you're doing work for a homeowner, and of course they're paying you in cash or check or a card, but they're not going to give you a tax form, you still have to report it. This is what a 1099 NEC, which stands for non-employee compensation, looks like. Again, make sure it's for the right person and for the right year. And then we're looking, these circles are in the wrong place, I'm sorry, but you're looking for how much is in box one, how much money did they make, and if any tax was withheld. I've never seen one with tax withheld. But again, these forms do not get issued unless there's at least $600 in transactions. But regardless, all income needs to be reported. This is what a 1099K looks like. Again, this is for those third-party transactions, those credit card. If you are an Uber driver, your passenger gets the job using the app. They pay through the app. So that app, Uber, is your third party getting you the jobs, and then just like Instacart and all those. The client, the taxpayer, your customer doesn't pay you directly. So that's that third party, is that credit card processor. And all we need on here is box 1A. What was the gross? That means total. What was the total amount that you received? Expenses. In order to claim expenses for self-employment, they must be ordinary and necessary for that work. Again, we're talking about business expenses, not personal. And all ordinary and necessary expenses that were incurred that you had for that self-employment have to be reported. Some people don't want to report things, but reporting and not reporting affects income, which affects how you fall on that earned income tax credit curve. So all have to be reported. Examples of some business expenses, and remember you can pause this at any time, are advertising. So maybe this is the flyer or the Facebook ads, or the billboards, or the yard signs, mailers, business cards. Maybe it's supplies, whether it be cleaning supplies or nails or whatever. Your business use of your cell phone or your internet to get those jobs. Rental space, if you have a booth at a flea market, or if you're renting space in, for example, I had one lady who was baking some really neat desserts, and so she rented a kitchen. They have rent-a-kitchens, storage facility. They're renting a storage facility to store all their stuff because there's no room at their house. That's fine. You can claim the storage facility, but if your personal stuff is in there as well, you obviously can't claim all of it, maybe a part of it or none of it. Supplies. So what are the costs of the general operating supplies that you need? So if you're a landscaper, it could be that weed trimmer. weed trimmer line. Um, it could be pens and paper. What are the supplies that you need? Those mops, those dust rags, taxes and licenses. So if you are a business, you're supposed to have a license and have to renew it. It could be a CPR license if you're in home health care. Cost of educational expenses. So if you want to take a class to continue your education to get better at what you're doing, and sometimes it's a required thing, again, that CPR class, maybe you go to a conference, those are expenses as long as they are for that line of work. Of course, there's office expenses, pen, papers, toner, ink, postage. You have to create those invoices. Maybe there's a software you use. Legal and professional fees, rental fees of equipment, machinery, and vehicles. So you have a big catering job, you run an oven. You have a big, you do party designs and you run a truck for an event. That's okay. You can rent a vehicle, but if you rent a vehicle, it has to be less than 30 days. If you rent it for more than 30 days, this program, cannot do your taxes. You have to go to a paid preparer. For tools and equipment, we don't do depreciation. So no vehicle depreciation. That's out of scope for us. So if they have a truck, um, those kinds of things, those that they're buying, that needs to be depreciated over time. If they buy equipment, if it's under $2,500, you can put it on the return, no problem. Any one item that costs $2,500 or more and it is expected to last more than a year needs to be depreciated. We're not allowed to do that. And what that means is, since that item is expected to last maybe 3 years or 5 years, the cost of that item has to be spread out over 3 or 5 years. You can't claim the cost all in this year's taxes. Now, if you buy a pallet of grass because you're a landscaper doing a yard, that's not going to last a year. That's not a supply that or a tool that you have. That's something you bought and that you're putting right out to your taxpayer or to your customer in their yard. That's different. Some examples of big ticket items that will not last more than that would be allowed. Sorry, some examples that would be allowed is that power sander costs $300. Yes, it's going to last more than a year, but it's under the $2,500 mark. That's okay. Riding lawnmower, it's going to last more than a year. As long as it's under 2,500, we can put it on the return. If it's more than 2,500, we can't. And we're supposed to mark them under other expenses. We're supposed to say de minimis asset, type that in there. So yes, it is an item that should be depreciated, but because it's under 2,500, it doesn't have to be. So we're supposed to kind of code these, just so you know. Vehicle expenses. VITA can only do standard mileage rate for car expenses. In 2024 and I believe in 2025 as well, it is 67 cents per business mile. We enter the miles, the system will calculate how much that's worth in dollars. It is out of scope for us to use actual expenses. So sometimes they'll come in and they'll say, well, I spent X amount of dollars on tires and a transmission and windshield wipers, and we can't do that. If they want to do that, they can. They need to go to a paid preparer. It's much more involved. We just don't do that. We do mileage only. And for most of our clients, it's actually a better deal. The standard mileage also covers what it covers, that 67 cents per mile, covers the depreciation. That means the wear and tear, the decrease in value of your vehicle, the lease payments, maintenance and repairs, gasoline, oil, insurance, car washes, vehicle registration fee. It covers all that. The only time you can claim insurance is if you are an Uber Lyft driver and then you notify your insurance company that you're going to be an Uber, you're going to be moving people, passengers, and then you get maybe a rider to cover those passengers. The cost of that rider to your insurance policy that covers those passengers is the only thing you'd be allowed to claim. What miles can you claim? Well, from your home to your first stop of the day, that's commuting. Nobody can claim that. Your first business stop of the day. Everyone has to get to work and get home on their own. If not, then if I worked at Walmart or Target or McDonald's, they have to pay me to get to work and pay me to go home. And that's not allowed. You're responsible to get to work and get home on your own. If you, some people are like, I live in Lehigh. Some people work in Naples, which is south of another county from me. Um, and they want to claim those miles because it's so far and they drive there every day. Well, the IRS didn't tell you you had to work that far away from home. You chose to work that far away from home. Everybody has to get to work on their own. So if home to your first stop, you can't count. But if you leave that, maybe you're cleaning 5 houses today and you leave your home and you go to your first house. We can't claim those miles. But when you leave that first house and go to your second house and then to your third, and maybe to the store to buy some more bleach and gloves, and then to your next house and your next house, you can claim all those because you're driving for the purpose of business. And then from your last stop home, you cannot claim. Now, if you make a personal, excursion during that day, obviously you're not supposed to claim that as well. If you have to go out of the area, maybe a lot farther than normal, it's not normal for you, for like a one-time thing, that's a temporary thing. So that those miles would be allowed from your home there as a kind of a one-time thing, as a temporary. But you have to be mindful of that. What I tell some people to do who are Uber and Lyft drivers, if you accept your first job while you're sitting at home and then go pick up your taxpayer or your passenger, you're technically not supposed to claim those miles. So you leave your home and you go to a gas station and put gas in your car so you can work for that day. Now you're at the gas station with a business intent. You're there for business purposes. You got to put gas in the car. From there, you can start tracking your miles to pick up that client. And if your last client or passenger of the day is really far from home, then stop near a gas station close to home, fill up your car again. Don't just stop there to buy soda or coffee. You have to have a business reason for doing that. Same thing with if you are in janitorial work. Stop at a store close to home and go buy some more supplies to be ready for the next day. Now you're at that store for business purposes. And then from there home, you don't claim those miles. Keep a record of what you're doing. You have to keep track of your miles. Let's talk about Uber and Lyft. When it comes to miles, Uber only tracks mileage when the person is actually in the car. So you have the app, you accept the job, and you might have to drive 10 miles to pick them up. Uber's not tracking that. They only track when the person's in the car. From the moment you pick them up to the moment you drop them off. Lyft starts tracking as soon as you accept that job. So once you accept it, they track your miles from you to pick up the person, drive them around, and drop them off. But if you're an Uber and Lyft driver, once you drop them off, usually you go park somewhere or drive around staging in an area to get your next job. So a lot of people go to the cell phone parking lot at the airport or go to a mall or down a busy, near a busy part of town where there's a lot of restaurants and stuff. And so they're sitting close by where they know they're going to get another job. So you're driving there for the purpose of business. You can track those miles. But again, nobody's tracking this for you. So they need to be tracking them themselves. There are some really good apps out there that can help with this. Some charge a fee and some do not. And sometimes they can crash. So I did have one client who it crashed in July and she didn't have her records for August to December because it crashed. She lost that information. So it happens. It's good to have a log. Uber and Lyft also provide their drivers with an end of year statement. These are the only two companies I know that provide this. And you cannot, should not, do not do their tax return without the statement. And if it's their first time coming to you, they're not going to have it because they don't know. They might come in with a 1099 NEC. They might come in with a 1099K. They might not come in with anything. They know they have to report it, don't know what to do. If they're an Uber or Lyft driver, have them get on their phone. That's where all their information is. It's on their app. Don't finish their return without this. And here's why. So this is an example of an actual Lyft statement. Lyft will track the miles. So in this case, you see 27,977 miles. Again, they don't track all the miles. They track most of the miles. It's going to show the gross earnings. Now, tax forms 1099 NEC and 1099K will not be issued unless the driver has crossed a certain threshold. So just because they don't have a form doesn't mean they don't have income they need to report. So you do need to see this form. And in this case, you see there's $39,188, and then there's $3,994. So they should have those two tax forms with them. But if the amounts are smaller, they may not. That income still has to be reported. That gross earnings you see there must be on that tax return Schedule C. Look at the expenses. Lyft charges a platform fee, a service fee, and a third-party fee. So the platform fee is basically you paying them to use their app and get those jobs for you. They have to make money, and they're helping you make money, so you pay a fee. That's a huge portion of it. Then there's service fees, and then there's third-party fees. That's the credit card processing, all that kind of stuff. So every credit card, there's a processing fee. They're not going to pay for that. They pass that on to you. So if you look at all this money they got charged in fees, it's like a third or a fourth or more of what they made. You need to enter this. If you don't enter this, if you don't have this form, you don't enter it, they have to pay taxes on all their earnings. And they shouldn't, because they didn't make all that money. This is an example of an Uber statement. Again, you see the miles, but remember, they don't report all the miles. They also have the gross earnings over on the left-hand side. They also have their expenses and fees there in the middle. And then the net payout is the two separated, their net earnings. They may not have a tax form. You still have to enter it. They may not have this form. Don't do the return without it, because self-employment tax is 15.3% of whatever they make. That's a huge amount of money, and that doesn't even include income tax. You need this. We need to reduce their income by what is allowed, their expenses, and those are expenses. When you are entering Uber and Lyft and any self-employment, you're going to have multiple types of income sometimes. When you enter it, my biggest suggestion, piece of advice I can give, because I have a lot of people who are Uber and Lyft, don't combine all the income into one number when you're entering it on the Schedule C. So this is a Schedule C income menu. We only put information in the top box. The other three boxes, we're not going to put anything in. All your 1099Ks, your cash and checks are going to go in this top box. If you have a 1099 NEC form, you enter that as a regular tax form and connect it here. But your 1099Ks and any cash or checks that they get and they tell you about are going to go in this menu in that very first line. And so what you're going to want to do is you're going to want to hit those three lines that are in that little box on the right hand side. And that's going to open up a box that allows you to type in a description. I strongly suggest that you do this. So for example, if somebody is an Uber and Lyft driver, I'm going to hit those three lines. The box is going to come out. I'm going to type Lyft 1099K, put in how much I made. Then I'm going to add another one, and I'll put Uber and how much they made. And what that's going to do, it's going to add those two numbers together and stick it in that very first box there on the left that you see. Why am I doing this? Well, first of all, I have my quality reviewer coming behind me, and he's going to be like, how did you get that number? And then he has to add it up. So number one, I'm always hitting the wrong numbers on a calculator. I got fat fingers when I try to do a bunch of adding. I don't want to make a mistake. Number two, I don't want the quality reviewer to have to add everything again up, to add everything up himself either. All he has to do is click on the three lines and he can see a list of what I've done. Also, when I print this tax return out, anytime I do this kind of description, clicking those three lines and typing things out individually, it's going to print at the very end of the return an itemized list. Everything I type out like this is going to show up. So when I'm trying to explain the tax return to the taxpayer so they understand it, or if next year they come back to me, it doesn't matter. I want to be able to look at it and understand it. Where did this number come from? Here's where it came from. It is so much easier for myself, the taxpayer, and then if they get audited, or if they're trying to determine are they making any money, where are all their expenses going, breaking things out like this is very helpful. Almost always when you have somebody who's self-employed, they're going to owe money, especially if it's their first year. And you're going to get this warning message that pops up anytime somebody owes over $1,000, even if it's not self-employment. Maybe it's their W-2 or retirement. If somebody owes more than $1,000, you're going to get this error message. Please do not click the fix it button. Just leave it. Just hit continue. If the IRS wants to charge them a fee, let them charge them a fee. You don't need to click anything. Clothing expenses. So depending on the type of job that people have, they're going to have different types of expenses that they can or want to claim. And a lot of times they'll say they have clothing expenses. So first of all, is the clothing required for your employment? Well, and I don't mean you can't go naked. That's not what I'm talking about. Is you have to think, is it suitable for everyday wear or is it something that's specific to that line of work? So for example, scrubs. Yes, that's specific to that line of work. I wouldn't wear, if I wear scrubs in a restaurant, I'm working in some kind of healthcare field. An apron is suitable to cleaning or cooking. You wouldn't wear that normally in a restaurant if you were just there to eat. Dresses, suits, jeans, tennis shoes, shorts, t-shirts, you cannot claim those unless they are logoed for your business. Steel toe boots, absolutely you can claim. Again, logoed shirts, painter's overalls, any kind of protective clothing, things like that, you can claim. Smocks, scrubs, those are specific to businesses. Those you can claim. Gifts. So if you buy a gift, if you're self-employed and you buy a gift for your client, maybe to thank them, or maybe it's for their birthday. If you're a home health worker, you get to know your clients and maybe you buy them a birthday gift or a Christmas gift or kids that you work with. Or if you're a realtor and you want to buy a gift for somebody who bought a home from you, you can claim up to $25 for an individual a year. If you spend more than $25 on gifts for somebody, you can only claim $25. And it's per individual. So if I spend $10 for one person, a gift, but I spent $30 on a gift for somebody else, I can claim the $10 and I can claim the $25. I can't claim the 40. And what I do is I'll put on the expense form, I'll put 7 clients, whatever it is, I'll break it down. So let's talk about different types of businesses that we normally see and what you think some ordinary and necessary expenses are. And when I say ordinary necessary, for example, a musician would be a songbook. That's ordinary necessary. You would expect that music. If I was a CNA, somebody who takes care of people, a riding lawnmower is not ordinary necessary for me to take care of that person. Um, so you have to think about what is necessary for that job. So pause these. Think about what a handyman, what are some expenses a handyman might have. Remember, every handyman is different. Tools, business cards, safety gear, of course. You have the hardware. Um, don't forget business miles and business use of cell. They have to have that cell phone in order to get those jobs and to coordinate things. If they use their cell phone for personal use, then obviously they can't claim 100% of their cell phone. They can only do that if they have two separate phones, one strictly business and one personal. Then they can claim the cost of the business one. But most of our clients don't have that. We're dealing with lower income, small, and one man shows. So I would ask them, how many months did you do this work during the year? When you think about the whole month, the time on that you spend maybe talking to your friends and family on Facebook, looking at stuff online versus how much time you spend on your phone for business, what percentage? It's up to them to come up with a reasonable, accurate percent. So somebody who cleans houses or offices, somebody in the janitorial line of work. What are some expenses you might think are ordinary necessary for that? Chemical supplies, equipment, and of course, business miles, aprons, those kinds of things. And they could have other stuff. And of course, business use of their phone for some of them. A realtor. We have lots of realtors. Advertising, business cards, lots of flyers, right? Business miles, business use of cell, the MLS annual membership. And sometimes, depending where they live, they have quite a few of those. Desk space, rental space in a realty office. Some of the realtors I deal with, they work with larger real estate agencies, so they have their name, and some of them charge, rent for the desk space, so they can use their name, and some don't. There's what's called the Supra key fee. And if you've ever seen a house that's up for sale, there's that little black box hanging from the doorknob that has a key in there, and they have to pay a certain amount of money to have access to those codes for those key boxes. And of course, there could be other expenses as well. What about a landscaper? Well, it could be the gas for their lawnmowers, not their vehicles. And of course, their tools, equipment, supplies, business miles, advertising, business cards. And if they have a lot of yard waste that they haul away, they have to take it to the county dump. There's those fees as well. Some people will say a trailer. Yes, if it's under $2,500. If they're buying a trailer and it costs 2,500 or more, then they would have to depreciate it, and then we can't do their tax return. And Uber and Lyft, we've already talked about a little bit. There's the business miles, business use of phone. Some drivers will buy water or car chargers for the passengers to use, and they're in the back of the vehicle. Some pay for an app to track their miles. Same kind of thing with Instacart and DoorDash. They're not hauling people, they're hauling goods. So sometimes they need those coolers to keep things hot or cold. I have some that will buy, they do a lot of Instacart kind of stuff. And so they'll have dollies or wagons to help them move the product. They'll buy bags, things like that. Now, now you know about the income and the expenses and the forms. Now we got to figure out how to enter it into Taxslayer. So if somebody is a self-employed person, we're going to start with somebody who doesn't have a 1099 NEC because they get paid in cash or checks from individuals, or they made less than 600 from a business. So first thing you're going to do is you got to start. If you don't have a 1099 NEC, you're going to start the Schedule C. You can find it on the income menu, or you can type in schedule in the search box. For everybody with a Schedule C, we have to say what kind of business it is. Now, for our clients, again, we're talking about those one-man shows. Most of them do not have a business name for themselves, but some do. If they do not have a business name for themselves, you skip the name and address on the Schedule C. Remember, we've already started their return. We are now on Schedule C. The computer knows who they are. I don't need to type their name and address again, unless it is for business. So maybe they do flooring, and so it's Tony's Flooring, or maybe somebody does a lot of baking and their name of their business is the Cookie Bouquet. That's a business name. And then we would need their business tax number and their address to go there. For all of them, we need a business type. We need to tell the IRS what type of business they are in. When you click on that blue link, it's going to give you a list of things to look at. It doesn't tell you everything, so find something that is close to what you're looking for. Do not use 9999999. Don't do that. But what is something they're similar that you can find in there that's similar to it? So somebody who moves people like Uber and Lyft, think about taxi and type in the word taxi and it will pop up. People who move goods like Instacart, DoorDash, another word for somebody who delivers stuff in the olden days was a courier or a messenger. So that's the code. You would type that in and we'll give you the code. People who clean houses, janitorial. People who cut grass, your landscapers. Well, that's landscaping. People who are carpenters and all that kind of stuff. You can look under construction, whether it be home or house. That's how you can kind of find things. You can scroll or type in keywords. When you get into the Schedule C, once you've entered that code, this is the menu that comes up. You're only going to be using these 4 sections that I have the red arrows next to. You're going to have income, general expenses, which is like a menu. You just kind of type things in. There's car and truck. This is where we enter the miles. And then there's other. I love the other expenses because I like to type things out. You can do that in the others, but there's a lot of things that don't fall neatly into the categories. So first, let's talk about income. Remember, before we talked about income, only enter stuff in the very first box. Leave the other 3 blank. And again, if you have more than one source of income, you're going to type them out here by clicking those 3 lines. This is for other income that is not a 1099 NEC. So in this example, we have a 1099K from Uber, a 1099K from Lyft, and we have some cash tips. And so I would enter it just like you see here on the right-hand side. I would enter each one separately. The system's going to add them all together and stick it in that big box. But if I just put that grand total in that box, my quality reviewer is going to be like, where'd you get this number? And then, a few months from now, or when I'm explaining it to the client, whatever, next year, how did I come up with this number? If I type it all out, it'll be written out on the last page of the return. When you're under general expenses, you have this long menu here in the middle of all the different categories. You can enter some stuff. Notice there's those 3 lines again. Combine some things. You don't have to list every single item one by one. You can combine some things. So office expense, I would put printer, ink, and paper under one, and maybe I'd do another for postage for invoices. There's one that just says supplies. You can put a grand total for supplies there. But maybe they broke it out by chemicals and mops. You can do that too. You can do 2 separate categories. I think the more detail, the better. Just so you know, the IRS says they can audit you in 2 to 3 years, but they actually could audit you up to 6. So keep everything for at least 7 years. If there's something wrong with this return, the IRS isn't going to audit you right now. As soon as it's e-filed, they're not going to audit you probably a year from now. It might be 2 or 3 years later or 4. So be detailed, because nobody's going to remember how these numbers were made, where they came from. And here's why I like the other expenses, because you could just type things out. Business use of phone, scrubs. Now you could just use business use of cell phone, But then again, how did I come up with the $72? I like to be more detailed. So what I do is I'll put in that smaller box there, business use of cell, and it says $50 a month for 12 months times 40% equals 240. Because next year, how did you get that number? They get audited. How did you get that number? When I explain this to somebody, how did you get that number? My quality reviewer, how did you come up with the 240? Be detailed. This will print on the return. For our miles, this screen is wrong. This is actually from a previous year. We only have one box for business miles. It's for the whole year. We don't have this box here in the middle. There's a place for commuting and then for other miles. That would be your personal use. Description of the vehicle does not need to be complex. It could be Ford. Oops. It could be Chevy. It could be 2017 Cherokee. Whatever you want to put. When did you first use this vehicle for this job? And then just fill in the rest based off of their answers. When you're done with the Schedule C, you'll see a summary. So on this screen, there's actually two Schedule Cs that you can see here. One that I had finished and one that I was currently working on. Above it, you see a grand total of all Schedule Cs. So we have a special food catering kind of Schedule C. They made $10,000 and they had $60,000 or $60 in expenses. I totally made these up. These, just so you know. And then we had the Uber Lyft driver, $20,000 in income. I haven't got around to entering the expenses yet for a total of $20,000. I was just wanting to show you that it combines it so you can see overall what was their income and profit from self-employment. And those little pens, you can edit things. Whenever you generate a Schedule C, you're going to see the little printer icon come up on the income menu. You can click on that to see what your Schedule C looks like. That's how you enter it when you do not have a tax form, 1099 NEC. Now I'm going to show you how to enter in Taxslayer when you do have a 1099 NEC. If you do have a 1099 NEC, always start with the 1099 NEC. So just like everything else, find the form, key in the information. Once you're done with the information and you hit continue, the system's going to say, we need to transfer it to a schedule. What schedule do you want to put it on? Do you want to put it on a Schedule C for business or a Schedule F for farm income? We do not do farm income, by the way. So you're going to select Schedule C, and then you're going to move through it. You're going to have to do the business name, business code, and then you can do the income and expenses, just like I showed you before. If you have more than one 1099 NEC for this company, for this work, put them on the same Schedule C. Remember, you're doing a Schedule C for your business. You could have a lot of tax forms for your business. If you were in landscaping and you cut grass for 4 banks and 2 real estate companies, each one of them is going to give you a tax form if they paid you over $600 in the year. That's 6 forms right there. And then you might have done cash income for a bunch of houses. So you could have a lot of 1099 NECs. You do not do a Schedule C for every tax form you have. It's for every business you have. So if you're a landscaper, you're going to do a Schedule C for landscaping for yourself. If you're an Uber driver, you're going to do a Schedule C for your Uber driving, for your passenger driving. So it can be Uber and Lyft combined into one. You cannot combine 2 different types of businesses on one Schedule C. Each Schedule C is for one person, for one type of business. I have a couple, they're both Uber Lyft drivers, and one of them is also a janitor. So I have 3 Schedule Cs on there. You can have multiple Schedule Cs, but it's one Schedule C per business type per person. If you do have a second 1099 NEC that needs to go on the same Schedule C you started, as soon as you get to your Schedule C income or Schedule C menu, I strongly suggest you go back and click 1099 NEC again. I believe you should put all your income in first, then work on your expenses. It's easier, you won't make a mistake. Just like a tax return, income comes first. Do all your income first. So you're going to click on the 1099 NEC, you're going to fill it out. Just like before, it's going to say, hey, is this business or farm income? You're going to select business. And then it's going to say, do you want to create a new Schedule C? Or do you want to report this on one that you've already started? And so if you look here on the screen, you'll see that this return, I've started one that's for couriers, like Instacart, one that is taxi, probably an Uber driver, and one that did home health care. So this return has 3 Schedule Cs on it. Every 1099 NEC has to be connected to a Schedule C. If you don't connect it to a Schedule C, it's not going to calculate the correct taxes. It won't calculate the self-employment tax, which is 15.3%. You have to connect it. When you look at the very top of the screen, when you look at the summary of all the 1099 NECs on this summary at the very top, you'll see one says carry to the Schedule C and one says none. So that has to be fixed before the return can be done. There you can see it again a little better. When you have a 1099 NEC and you link it to the Schedule C, when you go into the income menu, you'll see the amount of the money from the 1099 NEC above the box, the first box. Now they updated the system. Instead of the right side of the screen, it's on the left side, but regardless, the money that's not in the box, in this case $4,500, was actually from a 1099 NEC. It just carried on to this Schedule C to be combined with that $1,000. So they actually made, or is it 10,000? My eyes are, I think it's 10,000. So they actually made $14,500 with this job. A lot of times when you have self-employed people, they're going to owe money. Your taxpayers need to understand that we are a pay-as-you-go society. People who owe $1,000 2 or more years in a row might get hit with an additional penalty. They were very lenient about this for years, but not anymore. I've had quite a few taxpayers that I've been warning about this. They're going to charge you. They're going to charge you. They have the right to charge you. They're like, no, they haven't yet. They haven't yet. And I got a few phone calls this year. And, oh my God, they finally started charging me. Guess I'm going to start, taking care of that. So, they have the right to charge. So not only do they have to pay the amount they owe, probably interest and penalties because they're not going to pay it on time, and now they have to pay another penalty for being over $1,000, it adds up fast. For people who are self-employed, they are supposed to be sending in their tax money quarterly. And those are called estimated payments because they have to estimate what they think their tax is going to be, and then they have to send them in quarterly. And we can help them with those vouchers to get them ready, kind of walk them through it. And what happens is when they send the money in using these estimated quarterly vouchers, the money sits on their account, the IRS holds on to it, so that when they file their return, they have the money already there and they won't owe so much. And again, we can print them for them. They need to keep good records because if they do make a payment for estimated payments, I'm talking about paying ahead, not paying back when they owe, they need to tell whoever does their taxes next year, I made an estimated payment, and they say when and how much it is. That way it can be entered into the computer system, and that way it'll show that they owe less money, that they actually made a payment. It's great to pay ahead. At the end of the year when you file your taxes, they're probably not going to have the money. They need to put it away as they make it and send it in every quarter so they don't spend it. Clients who owe, a lot of times get stuck in this loop, this snowball effect, especially if it's their first year being self-employed. They owe money when you file, so now they're working on paying back, but they don't feel they can pay ahead, especially if it's a very large balance. So they're worried about paying back. There's penalties for not paying on time. There's all this interest, and it grows and it grows, and this balance grows, and they're making their payments, but they're not putting any money aside. They're not sending in their quarterly payments to the IRS during the current year that they're in. And so when they file the year that they're in next year, they owe again. And it just compounds and just grows and it grows. And they're in this cycle they just are never going to get out of, a lot of them. And the debt just grows and grows and grows. And the interest amount is just crazy. They compound it like a credit card. When your taxpayer owes money, whether they're self-employed or not, we can help them do a direct debit payment if they'd like. We cannot use cards. We actually have to have the routing and the account number. But if they want to schedule a payment, they can. It does not have to be the full amount. If they can only afford $50 or $20 or $100, we can enter that in the system for them. It doesn't even have to be paid that day. They can schedule a future date, but it cannot be past April 15th, whatever the last day of the filing season is. And so this year it will be April 15th. Whatever day, whatever amount they pick, the system will not print a receipt. So first of all, we don't give receipts because we're not actually making the payment. We don't take the money. But we can show that the payment was scheduled. And the only way that you can print something to show it was scheduled is to print what's called the quality review print set. And that has a lot of detailed information. And I just print the first page of that because it'll have the bank information on the bottom. I circle that and I show it to them. Make sure this information is correct. This is when it's scheduled to come out. This is not a receipt. It's up to you to monitor your account to make sure the money comes out that day or within a week. If it doesn't come out, you need to call the IRS to see if there's a problem. Don't assume it's been paid, because if there's an issue, you think it's paid and it's not, and then all of a sudden you have a balance due. So please, please, please make sure this routing account number is correct. Verify the amount and verify the date. Okay, so having said all that, you now have everything you need to finish Stephanie Winter's return. This return was started with training number 3. It's on page 92 of publication 6744. This is the second half of it. So pause this while you get your book out. Remember to have a highlighter, to have a pen. We're going to finish this return. So the parts that we did not touch on last time was Stephanie is self-employed, delivering meals for Fast Eats on the weekends. She received a Form 1099 NEC and a Form 1099-K. She received additional cash payments of $570, including tips. She uses the cash method of accounting. She uses business code 492000. So they helped you out here, so you don't have to search for the code. They're giving you the business code. But I really think you should practice trying to find it. She also provided a statement from Fast Eats indicating the fees paid for the year. These fees are considered ordinary and necessary for the food delivery business. And so on her statement, there was $150 for an insulated box rental. This helps keep the food hot or cold as she picks it up, makes the delivery. She also had to pay $50 for a vehicle and safety inspection that was required by the company she's working for. And they charged her $600 for Fast Eats fees, probably to use their app. She also kept receipts for the following out-of-pocket expenses that she was not reimbursed for. She paid $80 for tolls while she was making deliveries. She had a speeding ticket and she was charged $300. And then she was out on the road so much that she ate some lunches and it cost $160. Stephanie's record keeping application shows she has driven a total of 3,000 miles during and between deliveries. She placed her only vehicle, an SUV, in service on March 15, 2020. The total mileage on her SUV for last year, or for the tax year, was 12,500. Of that, 9,500 were personal and commuting miles. She will take the standard business mileage rate, which I hope, because that's all we can do. Oops, they're the same things again. I do want to come back to this though. When you look at these expenses, what is ordinary and necessary to do that business? What is a business expense? Think about that versus personal. This is what her 1099 NEC looks like. Make sure you highlight box 1. Make sure it's for the right year and for the right person. This is her 1099K for third-party transactions. You only need the information on 1A. Always make sure it's for the right year and for the right person. You have everything you need to do this return. You are continuing with the return that you started. So you're going to open the return you did last time. When you log into Practice Lab, make sure you click on Client Search, click on Stephanie Winter, open the return back up, and enter the information from the rest of this scenario. And then answer the test questions on page 105. So the whole entire scenario is in your book, publication 6744, starting on 92. There's also the intake form, everything is there. So make sure you go through this, finish the return. When you think you're done, go back and look at your intake form. As you're looking at your intake form now, was there anything that was discussed that was not, you don't have a tax form for? So anything on those interview notes that you do not have a tax form, you should technically be writing them on your intake form. Make it a habit. Start getting used to doing that. What you should be working on when you're done with all of this is do the intake interview and quality review training. It's on the same link as last time, the ethics page. It's just below it. Watch that recording, and then in your test book, page 21, there's 10 questions you can work on. You have study guides. They're also on my webpage. Start working on the advanced scenarios, number 1 through 6. Make sure you use your study guide. Apparently I have a typo there. Also on the webpage. Get familiar with your publication 4012. Look at sections E, J, I, and J. Those are the ones from credits. They had all the credits on it before. Also, student loan interest deductions, educator expenses, those kinds of things are in E. Remember, you don't have to memorize anything. You should just become familiar with it. And play in that practice lab. Have fun, get comfortable with it. If you have questions, please ask. We're here to help you. And remember, drop-in sessions are available in person if you live in Fort Myers, Lee County. But they're also on my website every Saturday from 7 to 9 p.m. You can drop in on Zoom. Don't forget to answer the questions, page 105. Use your study guides. And I'll see you next time.